Hi, welcome to this show. Today I have the distinct pleasure to bring to you Saurabh Mukherjea. He's the founder and chief investment officer at Marcellus Investment Managers, which offers portfolio management services, uh, better known as PMS. He's the former CEO of Ambit Capital. He's, he's an alumnus of London School of Economics, and above all, he's been an accomplished author. He's written 4 bestsellers: uh, Gurus of Chaos to start with, The Unusual Billionaires, Coffee Can Investing, and of course, the recent one, The Victory Project. Uh, I've been reading this book, and I can definitely tell you this is one of the best books that I have read in this multi dimensional space. So he has deep experience in investing and being an entrepreneur. He can speak a lot about entrepreneurship as well. So I'm sure we are more keen to hear from him. So without much ado, let me step back. So welcome, Saurabh. Thanks for your time.
Thanks, Sanjay. Thanks for inviting me. Really good to be here.
Pleasure. So you've had a very accomplished career uh, in the field of investments, and you have also started your own venture. What led you this path?
I think very kind of you to say that. So when I was a teenager, so my parents migrated to the UK when I was 14. And then through my teens and my early 20s, I worked in a betting shop, which pretty much paid for most of my education. And in a betting shop, as a teenager, as a 17, 18, 19-year-old, I saw that hundreds of people came to bet on horses, on dogs, on cricket, on football. But in one or two people would consistently make money.
Oh.
And that's what really got me interested, that it's the same activity, it's the same amount of information available,
Right,
right?
right.
And yet one or two customers make money consistently, and 99% of the people who come to the betting shop consistently lose money, yet they keep coming back, right?
Oh, okay.
That's also a fascination. So that's when the first sort of stirrings came through, that in a way, as much as anything, curiosity about human psychology.
Huh.
Why do 1% to less than that of investors consistently make money, and why do 99% lose money consistently and yet stay at it?
Hmm. Hmm.
So that was the beginnings, and then I went to the LSE. After LSE, I had the fortune of being introduced to a man called John Kay, who's been a lifelong guru for me. John taught me about things like comparative advantage. Right, in college in LSE, I hadn't really learned anything such as comparative advantage. That was more about GDP growth, or in microeconomics, things like adverse selection, moral hazard. John taught me the whole concept of comparative advantage, and he's written a very good book on the subject called Foundations of Corporate Success. And under John's tutelage, I learned how to analyze businesses. Then I became a management consultant. And I became a management consultant at what was called Anderson Consulting, then became Accenture.
Yes.
And finally, when I was 27, I entered the world of equities.
Okay.
I became an analyst in a company that I co-founded in London called Clear Capital.
Okay.
And that was my beginning. That was 2003. And here we are 17 years later. I'm fortunate enough to work with a really good group of people in Marcellus Investment Managers, where we use the constructs that John Kay has taught us about comparative advantage, long-term sustainable comparative advantages, moats, how to identify them, how to quantify them, and then how to turn them into successful investments for our 4,000 odd clients.
Fantastic, fantastic. So there's a lot of similarity between the journey that you've had and my journey in some sense. I mean, from consulting to investing, and
Right.
I've dabbled also in the private space. But I believe the fundamentals of what you mentioned about investing is also hinged on your understanding of the business, and to begin with, say, competitive advantage. How do you draw parallels between, say, private space investing and public market investing that you are more accomplished with?
I think thankfully we don't have to use our brains too much. There's a man called Peter Thiel who's thought about it for all of us. And I think in 2014, right, he wrote this remarkable book called 0 to 1.
Yes.
And for those who are watching this and don't like reading, if you don't like reading, obviously there's challenges ahead for you. As Charlie Munger has said, he's never met a smart person who doesn't read non-stop. And one of the most interesting things I enjoyed, Sanjay, about your book on angel investing, is your own desire to read widely and write widely. But for those out there who don't want to read either your book on angel investing or Peter Thiel's 0 to 1, then one via media is there's a lovely YouTube video
Oh,
called Competition is for Losers. There's a book
okay.
called, there's a YouTube video by Peter Thiel called Competition is for Losers, which is basically the essence of 0 to 1. And what he's explained is the world over, whether it's listed, unlisted, whether it's in India, Bangladesh, Tanzania, or USA, the central construct of successful corporate life and successful investing is building a monopoly.
Yes.
So as he says, 99.9% of businesses fail to escape competition. If you fail to escape competition, you might as well not bother building a business, because if you fail to escape competition using your previous life construct, you're not going to generate any economic value. And if you
Yes.
don't generate economic value, your business will be worthless. Now the question, and this is where Thiel I think has been outstanding, right? He's basically used his friendships with and his ex-colleagues, people like Elon Musk. He studied people like Zuckerberg very carefully, and he said what's happening across the world is there are a few people like Jeff Bezos, like Elon Musk in the American context, who figured out how to build monopolies.
Hmm.
And the typical construct is they start by monopolizing a niche underserved category, and
Sure.
then they sort of move in concentric circles outwards, right?
Right.
And so we came across Thiel's book in 2014. We combined that with our own understanding of competitive advantages,
Hmm.
and we realized that a group of Indian promoters around 40 years ago had preempted Thiel, right?
Hmm.
So
Hmm.
people like Champak Lal Choksi, the Asian Paints founder,
Hmm.
Harsh Mariwala Saab, the Marico founder, the
Hmm.
Parekh family behind Pidilite. These people
Hmm.
had preempted Thiel, and that they had also figured out that the
Hmm.
way to make money is you build very deep barriers to entry, very strong moats around a
Hmm.
niche industry.
Hmm.
You build your systems, processes, your staff strength, your technology in that niche area,
Hmm.
and then you use the cash flows generated by this dominance in that niche
Right.
area. You reinvest that to move in concentric circles outwards. So to take
Sure.
Pidilite as an example, 1970 to 2000 they monopolized adhesives, Fevicol, right?
Yes.
2000 is when they started their journey in monopolizing waterproofing.
Yes.
In the last 20 years, they've basically monopolized waterproofing, right?
Yes.
And
Yes.
now over the last 2 to 3 years, you can see they're now moving into things like specialist flooring,
Yes.
flooring for hospitals, for sports stadiums, for high-end homes, and the EPC work around the same, right?
Sure.
So classic Thelian construct, and Asian Paints too, right?
Hmm.
Is started by a paint business which has gone in concentric circles outwards.
Right.
Now, as you might have seen, they're trying to move into the entire home. They
Right.
recently bought a interior decoration company. Now, where I think the Indian promoters came up with a construct which is not as clearly elucidated in the Thiel construct is the Indian promoters figured out that the way you got to go about it is not only do you have to start by building a moat around the hardest aspect of the business,
Hmm.
right? That I think Thiel also has nailed,
Yes.
but on an ongoing basis, you have to make the nature of competition more and more difficult,
Yes.
so that
Yes.
even when others see you're successful, they can't compete with you. So
Right.
let's take Dr. Lal Path Labs, right? So the easy way to enter a path lab business is to raise buy a whole bunch of money from
Sure.
private equity, stock market, and go and open a lot of labs.
Sure.
But obviously that's not going to be very useful. No, there's no barrier to entry there.
Sure.
So they figure out, I reckon around a decade or so ago, and I think Om Manchanda has been central to this endeavor at Dr. Lal Path Labs, is the use of technology,
Hmm.
especially
Hmm.
databases which give you data on footfalls, on rentals,
Hmm.
on the proximity of organized competition. They figured out in their NCR Fortress franchise, in their
Hmm.
NCR region Fortress franchise, how to optimize the location of their outlets, of their franchisees.
Hmm. Hmm.
Because in the context of path labs, your blood test and my blood test, I can't really say mine's going to be that much better, right? So how do I optimize? How do I create a moat? I grab the best locations
Hmm.
on every high street in the NCR region,
Hmm.
and then in true in true Thelian style, they in moving in concentric circles outwards into say Lucknow and then Patna and Kolkata. But the added element is every year they're making it harder and harder for the competition to come in
Competition.
by putting more and more technology into the business. So
Understood.
now you want a Dr. Lal Path Labs test, it's on the app, the results are on the app. You can trace the progress of the fellow who's coming to take your, blood
Sure.
and so on.
Sure.
And
Sure.
and
Sure.
that aspect I think is similar to public and private.
Private. Understand.
Right? The central nature of moats and
Yeah.
monopoly construct is similar.
Yeah. So very interesting. This reminds me of one statement that Peter Thiel would make, and he's trying to allude to what Warren Buffett has been doing is investing in businesses with deep moats, like you just mentioned, with longevity and creating wealth. And he, in contrast, has been one of those who bets on disruptive ideas that lead to better and better progress for the larger society or the world. So he asks a question, and I'm sure you would have heard about it. Would you invest in a spaceship that goes to Mars, or would you invest in Mars, the candy? On one hand, he's alluding to Elon Musk, and the other, he's alluding to Warren Buffett. And
Lovely.
Warren Buffett, in his own right, has created tremendous amount of wealth, and there's no better investor known to the world than him. But there is this, what should I say, little distinction that Elon Musk and the likes of Peter Thiel will bring to the table is the question of the objective. Are you in the business of creating wealth, or are you in the business of enabling progress? And how would you like to, speak on this?
So look, I think it's fundamentally the same thing. I think if you think about it, the era in which drinking lots of cola and drinking, having lots of sugared candy was a great idea. Was an era, say, in which you and I grew up in. To be honest, to be fair to Warren Buffett, in the 80s and 90s, nobody
Yes.
really had that much of a problem with lots of sugared drinks and lots of candy. Right, and in that context, something like Coca-Cola made him a lot of money. Right. It's in the last 10 years that as it's become evident that whether it's smoking or sugar, that they are fairly poisonous for our body, the construct has changed.
Right.
But if you let's take an example where both points of view converge, investing in say Royal Enfield or Eicher Motors. As we have done in some of our portfolios, that's I think good for Royal Enfield. Royal Enfield is a good product. Royal Enfield customers get a high quality bike. Right. Royal Enfield shareholders get good returns. Their shareholders partake basically through the share price. They partake in the company's profits. The customer is happy, and the shareholder is happy, right? And there's a congruence of interest. Now, if you were to nitpick. You'd say, but Royal Enfield bikes pollute the atmosphere, and hence it's not great for society. I don't think so. So that's where I think the ESG debate becomes a bit misguided. Right? Royal Enfield customers want a luxury bike. Right. The company is willing to provide one. Both constituencies benefit. Yes, in the process, you do end up creating emissions, which create an externality for all of us, especially if you live in Delhi. Right. But that's not something we can ask either the customer or the shareholder to lose about. And that's where I think the ESG construct is getting a little misguided, where people are saying, I'm not going to invest in auto stocks, but they pollute the climate. And my view is that the two paradigms he's referring to, right, going to Mars and eating the chocolate. I mean, the company's unlisted. I guess we can't buy the chocolate anyway.
He's basically talking about what is the objective that each person should pursue. Is it creating wealth, as in having a larger bank balance, for a lack of better word, or enabling progress at the risk of losing wealth?
Yeah. So I would take
more
it
of
with
risk taking versus being risk averse. I think that's the
capitalists are here to make money, and I doubt it if Mr. Musk is built this remarkable rocket company. I doubt
Sure.
whether SpaceX or Tesla has any other overriding goal other than to make money. Now, the only difference is he's saying, I will make money by changing the world,
Yes.
right? I will make money by changing the world. And, congratulations to him. His ambitions are literally world changing. Right,
Sure.
his literally world-changing ambitions. The local kirana store is saying, "I will make money by serving the needs of people in the neighborhood I stay in."
Sure.
Congratulations to him. His ambitions are very useful for people in my neighborhood.
Hmm.
But both are fundamentally the same aspiration, and the distinction I don't think is valid. That Elon
Okay.
Musk is trying to make money by serving society. I don't think Hyperloop or SpaceX is any more about serving society than my local kirana store is about serving society.
Yeah.
Both are doing good
Yeah.
for the world. In the
Yeah.
process, they want to make money for
Yeah.
themselves.
So this brings to a very interesting juncture where if I am a budding investor or anybody is a budding investor or a budding entrepreneur, what direction would you guide them or what would you have to advise to them in shaping their lives? Because
Yeah.
at one hand you have the objective of making a dent, making an impact, and there are number of successful businessmen who vouch that they started a business or their main objective of being successful was to make a dent or leave a certain footprint, build institutions, create something meaningful for the world. Money, of course, is part of the capitalist, background, and people definitely end up that as a what should I say, as an outcome. But are they chasing that as an outcome is something that is debatable.
So
So
obviously, I mean, look, I think one has to be clear here. The only way you and any business can make money is by putting on the table a useful product or service for society.
yes.
If you start by saying I'm getting into business to make money, I think you're going to have a lot of trouble,
Hmm.
right? So Simon Sinek has put it very nicely: is to always start with why. Why
Hmm.
on earth am I starting the business? If the answer is I'm starting the business to get rich,
Hmm.
I think you'll have a little bit of a problem. So you have to find your why.
Right.
Simon Sinek Start with Why is a lovely book to read on that, and he gives lovely examples, superb examples, right? How
Right.
Steve Jobs positioned Apple way back in, I think, 1978 or 79.
Hmm.
As his why was, you are used to IBM machines, they're not so much fun. I'm
Hmm.
going to give you cutting edge, lovely, aesthetically pleasing
Hmm.
Apple machines, which with
Hmm.
very
Hmm.
different keyboard, different screen. And his whole advertising, his whole positioning from that day, and even after he's gone, is
Hmm.
based around the why. Why is we give to Sanjay Kulkarni beautiful products, handcrafted, aesthetically pleasing, good performance, but and premium end of the market, right?
Hmm.
So you have to figure out your why, because if you don't have a why, you don't have a business.
Yes.
Now, where I found your book on angel investing, Insider Secrets to Wealth Creation, I found it very useful. Was you bring out another very important facet to setting up a business. However good an entrepreneur you might be, however good an entrepreneur you might be, uh, uh, it's a long and tough journey, and there are very tricky decisions you'll have to make along the way
Right.
about who to hire after you've hired, how much to reward, who to
Yeah.
reward,
Yeah.
how much to invest at which stage, how much to pay yourself, how much to pay the rest of the team, um, when to look for angel investing or VC funds, when to look for angel funds or VC funds, at what valuation to dilute, right? To do that successfully over a long period of time, say over 5 years, 10 years,
10 years.
you'll need good counsel. You'll need
Sure.
someone who gives you solid, sensible advice. No one's going to get it 10 out of 10 right, but you need someone who will improve the probability of your decision making, so that 7 out of 10 decisions you work out in your favor. Now, the interesting thing is this sort of advice is A, very hard to get,
Yes.
B, extremely valuable,
Right.
right? Therefore, the best thing I think a founder can do is find such a mentor, a guide, an angel, for lack of a better word,
Right.
and give him or her a small stake in the firm,
Sure.
right? Because that facet of investing, that facet of the entrepreneurial journey is
Hmm.
extremely difficult, right? It's even harder here. I've created a company in the UK and sold it. I'm creating a company in India. It's
Hmm.
much harder to be an entrepreneur in India
Sure.
than in the West, because the external volatility
Sure.
is intense. So, for example, when COVID hit us, our office was shut for 60 days,
Hmm.
right? We can't access it. The office was in a red zone,
Hmm.
right? What are we supposed to do? We are managing monies for 4,000 people. We gotta, how do we give, how do we look after them? So,
Sure.
thankfully, because of advice from our mentor, we had the entire system on cloud. So, guys, it
Hmm.
was hard to set up new clients.
Hmm.
Existing clients you could continue servicing
Hmm.
because the whole IT platform was on the
Yeah.
cloud,
Yeah.
right? But that IT platform, building it as a startup, had cost money.
Sure. Sure.
Money that at the outset 2 years ago I might not have wanted to spend had our mentor not prompted me to spend. So I think the best thing you can do, if you've figured out your why as an entrepreneur, if you've got a cogent, clear business plan, is find the main mentor. If you can call it angel, and make sure it's someone who can give you sage counsel. Don't
Hmm.
look for somebody who can give you the best valuation. That's the most stupid thing you could do, is to
Yes.
run around looking for the best valuation. Look
Right.
for the person who can give you the best counsel as you go through, a 5-10 year slog to build a good franchise.
Yeah. On that note, I think what you have written in this book, the
Right, sir?
Victory Project, the 6 steps to peak potential, essentially, this is another way of learning from others' experiences. Because we may
Absolutely.
not
Yeah.
have access to some of these great entrepreneurs or successful people because for a variety of reasons. And the best way to learn from them is learn from their experiences. Because what
Lovely.
usually books tell you is what to do or what not to do. But there is a different genre of book, and that is a very small subset which talks about experiences. So if I can learn from others' experiences, I can
Beautiful.
imbibe that and apply on my own. And I'm sure people are intelligent enough to kind of draw these conclusions for themselves. All they need is this pool of water. And I think books like these are what I would call based on people's experience can be a reasonable starting point.
So I think you've hit the nail on the head. I think a guru, as I put it in the book, one of the key drivers of outside success,
Right.
I've described in the Victory Project, is having a guru who shows you, who gives you the sort of the productivity hacks, the decision making tools, uh, in the first 5-10 years of your career,
Yeah.
right? We Anupam, my co-author, and I, we got this construct from Robert Greene's book Mastery. But
Right.
then when we looked around us, we realized that there are many, many such people.
Sure.
Whether you look at Bruce Lee in martial arts, you look at say great cricketers like Sachin Tendulkar, right?
Sure.
The guru is a central facet of
Yes.
outside success, whether in business, in investing, in sports, or in the creative arts, right? And the
Yes.
guru basically, as you rightly put it, Sanjay, the guru distills a lifetime's worth of experience and knowledge into those 5-6 years where your business, your life is at the crossroads, right? Where
Sure.
you're at a very critical juncture. And so, for example, you got Sanjeev Bichhandani on the cover of your book, praising your book. Sanjeev is from my school in Delhi. For 14 years my senior, but he's
Okay.
brilliant at this. He's brilliant at this, right? So
Right.
whenever I've reached out to people like Sanjeev Bichhandani or to Mohandas Pai,
Yeah.
uh, they've been incredibly solid, sound, rational in their
Absolutely.
advice.
Absolutely.
And at those critical junctures of your life, if you can improve the odds of your making good decisions,
Right.
the guru can help you enormously. And
Absolutely.
that's why the chapter of your book where you cite some of the best angels in the country, I
Yeah.
really really enjoyed that. As soon as I got the book, actually, Sanjay, I have to be honest, I went to the chapter where the best angels in the country are
Okay.
are described. And I asked myself, how many do I know? And
Uh,
then I said, I don't know these three people.
uh.
How can I reach out to them? I'll ask Sanjay for an introduction at some stage.
But amazing. Sanjeev's is a very generous person in the way he kind of counsels and guides the entrepreneurs, and he's invested in hundreds of them and probably mentored many more people. One of the things that I must highlight here, and which is mentioned in the book also, is he believes in investing in people who don't need advice, because
Yeah,
he is not in the business of hand holding and leading people, but if need be, he is very open to giving the most honest and candid feedback. So the same question I ask one of his investing company, which is showcased there, and that person says, there's no better person to have as your mentor than Sanjeev. So it's a bit of a, what should I say, modesty or on part of Sanjeev, that he believes that entrepreneurs do the work and they are the ones who are building businesses. And in contrast, all his businesses say that there's no better person than Sanjeev to guide us in the right times.
So one interesting thing, for my, so Sanjeev Bikhchandani is inside the Victory Project. We've written a section on him.
Yeah.
I went to his residence a year and a half ago to interview Anupam, and I spent 2 lovely hours drinking chai and naan khatai biscuits with him. So when we published this book, The Victory Project, he did a interview for us on one of the TV channels.
Okay.
And he made a beautiful point there which just blew my mind. Sanjeev Bikhchandani said, I invest in companies which could raise money from whoever they want.
Right.
And it is my privilege, and they're giving me the privilege of opportunity to invest in their franchise. And he says those are the best investments to make. Where the fellow could raise money from anybody he wants. He could go to Bill Gates' family office or Jeff Bezos' family office. But I'm lucky he's come to me, and I regard it as a privilege to invest. That was the first time I'd heard VC talk like that. And I thought, my God, what an insight. That invest in companies where the promoter gives you the privilege of investing in that firm. Because normally the discourse is, I'm the Malik, you need my money, so I will talk down to you. He didn't do that. I thought it's done, nicely done.
Yeah. So coming back to this field of investment, we spoke about the purpose of businesses, the modes, the similarities between public and private, and the why of the business, and therefore one should evaluate some of those businesses which have all of these features. When you invest in your fund, right, can you draw some of these parallels that are common in, say, private
what
investment?
We tend to look for. So I'll just explain how we think about it. And the book Unusual Billionaires, 2016 book, our book Unusual Billionaires gives more color on this. Basically, we divide it into 3 parts, right? The first part is the governance piece, where we use the last 7 years of annual reports, put them in our fraud accounting framework. We've got 10 fraud accounting ratios. And every year around Christmas, we crunch through last 7 years of annual reports on the BSE 500 companies, and we compare them to each other on the fraud ratios. The more fraud ratios a company fails, the greater the amount of accounting naughtiness the promoter is doing. So the first layer is the fraud piece. That itself kills 80% of companies, right, where they have accounting issues. Amongst those cleaner companies, what we then do is we then go through 10, 15 years of annual reports to look at the promoter's capital allocation decisions. So when did he do CapEx? What did he do CapEx on? What happened after that? When did he do a buyback? At what share price did he do a buyback? How much dividend does he pay out? How much does he reinvest? How much does he pay himself? Right, versus paying others, right? So what you're trying to do is look at the last 50. Once you've established that the fellow is clean, you're then trying to see, is his judgment about capital allocation? Does he get more right than wrong? And that leaves, so if you started with, say, BSE 500, the fraud layer leaves around 80 odd companies alive. Out of those 80, I would say only 40 stay alive after you've looked at the capital allocation. The final piece is then barriers to entry. You're back to Thiel. You're back to barriers to entry. You're back to John K. And what you're trying to see is basically, is this business a monopoly or a quasi-monopoly? You want to invest in companies who effectively, practically don't have any competition. Obviously, they won't say this on their website. Neither will they organize a investor call saying we don't have any competition. And therefore, it leaves us with a little bit of a job to do, where we spend sometimes 2 years figuring out, is this a monopoly or not? And that means discussions with competitors, customers, suppliers. And once all 3 boxes are ticked, and unfortunately only 20 odd businesses in India tick all 3 boxes, you go ahead, invest, and you stay invested. There's very little buying and selling. And in that regard, Sanjay, the way we invest is very similar to private market investment. There's very little buying and selling in our investing.
Fantastic. So one quick question, and probably we can wind up with this. What happens in private investing is most of these businesses are susceptible to lot much of disruption, and there are lot many risks, right? Uh, Either at a promoter level, at the business model level, at funding level, whether you are capable of building the moat, whether you are actually capturing the monopoly position that you are intending to. So there is a whole host of factors that the promoters and early stage businesses have to wade through, which is not there to that extent in, say, a public equity investing. But the winds of disruption are there to blow or make a dent in these stable businesses as well. So how do you take care of that in your area, and what can you suggest for people in the private zone?
So lovely point. So let me unpack it into two parts, right?
Yeah.
It's a misnomer that public market investing is any less prone to disruption. Let's take something as basic as lending money, right? NBFC industry today functions very different from the way it functioned 20 years ago.
Sure.
There's enormous use of fintech.
Yes.
There's obviously use of CIBIL data, bureau data,
right.
But over and above bureau data, different NBFCs to a greater or lesser extent have created their own captive databases.
Right.
Based on, say, which postcode are you in, what sort of phone are you using, what sort of SMSs are you getting, etc. Right. So the industry has turned on its head in the last 10-15 years.
Sure.
Yet Bajaj Finance has rode through those 10-15 years.
Sure.
Right. So on the outside, it looks like NBFC industries जैसा था 10-15 साल पहले वैसा ही है, but it's actually changed radically. Now, what Bajaj Finance has done, and this is just as true, by the way, in paints in the context of Asian Paints or life insurance in the context of HDFC Life, is they have aggressively invested in very good technology. And say, for example, I think Bajaj Finance has stakes in 100 odd fintech startups who provide the tech and the AI which powers its forensic databases. Bajaj Finance is the largest user of Salesforce in the country. Salesforce, I reckon, some of its best data scientists from San Francisco sitting in Pune for Bajaj Finance, right? So on the outside, it looks like Asian Paints today is similar to Asian Paints 20 years ago. But inside, the SAP system, the big databases, the go-to-market processes, the working capital cycle has been radically transformed by the use of technology.
So at the end of the day, it boils down to the promoter's ability to, kind of envisage some of these things and be ahead of its, be ahead of
Not just that, it's not just the desire to be ahead. You also remember this costs money.
Yes, sure.
The money can only come if you build a monopoly in the first place, right? And this goes now to Thiel. What Thiel has pointed out, and the great Indian promoters figured out 40 years ago, is if I can build the barriers to entry and I can build the monopoly, I will then have the cash flow, which I can then reinvest to deepen the moat further. And what better way to deepen the moat further than technology? Right? So similar point of view in the startup world as well. You need to be thinking through and strategizing about how to moat your business. But unless you're able to get going and generate free cash flow or raise money, I'm afraid no amount of thinking is going to help.
So I think this is a big conundrum in the private space, early stage investing. The trade-off between cash flow versus versus wealth creation at the end of a certain period, because most businesses have to go through a little bit of rough before they start generating cash, and many choose to lengthen that period for the want of pot of gold at the end of a certain longer period. Now, depending on your ability to raise money, these trade-offs between cash flow versus wealth creation fall differently. Now, the moment we get into that, we will have a longer conversation. So in the interest of time, we will pass that as part 2. And it would be great to have you again and discuss at length about some of these issues. But let me take this opportunity to thank you on behalf of HarperCollins.
My pleasure.
Fantastic. It's a pleasure talking to you. And let's stay connected, and I hope we can have another round.
Yeah, absolutely.
Thank you so much.
Thank you very much. Take care. Take care. Bye-bye.